Welcome to Ito Analytics, the leading platform for providing volatility data and option analytics. This is Chapter 4 of Option Trading Tutorial Series. We will cover volatility surface in this chapter. Recall from Chapter 2, implied volatility is one of the parameters in Black-Scholes model. Black-Scholes model assumes constant volatility of underlying asset, but this is not true in real world. First, supply and demand are different for call and put. This leads to different implied volatility for OTM call versus OTM put. This is typical trading screen of option chain. We can notice that implied volatility on OTM call is different compared to OTM put. Implied volatility is around 74% on 4,100 call, but implied volatility is around 70.5% for 2,800 put. Second problem of assuming constant volatility is that market has different sentiment in short-term versus long-term. This leads to different implied volatility for different tenors. Back to option trading screen, we can see implied volatility is quite different for options with different maturities. Implied volatility of 25th Nov 24 3,400 call is 61.9%, but implied volatility of 27th Dec 24 3,400 call is around 70.6%. As implied volatility is different across tenors and strikes, option market participants created volatility surface to capture this market phenomenon and to bridge the theoretical Black-Scholes world and the reality. In short, volatility surface is a three-dimensional plot showing implied volatility across different tenors and strikes. This is a typical volatility surface. It looks difficult to understand, but we will go through this in details. Three-dimensional plot is very difficult to see. Option market participants usually prefer two-dimensional visualization for a chosen tenor. This is what we call the volatility smile. Here's an example of SPX 1-month and 3-month tenor volatility smile. From the smiles, we can see 1-month ATM implied vol is around 12% and 3-month 80% strike implied vol is around 29%. Next, we would like to talk about some characteristics of vol surface. First one is skew. For a given tenor, skew is the slope of the vol smile at ATM strike. This is 3-month vol smile of SPX, red line is the slope of the smile at 100% strike. Normally, skew is negative as volatility goes up when underlying price decline. In practice, market participants numerically approximate skew by calculating the difference between implied vol of 25% delta put and implied vol of 25% delta call, then divide the difference by ATM implied vol. Effectively, this is measuring the vol difference between OTM put and OTM call and expressing the difference as number of ATM vol. Higher the skew means higher demand on put versus call. Next characteristic is convexity. For a given tenor, convexity is the curvature of the smile at the downside and upside wings, which is shown as red arrow in the graph. Curvature exists because far OTM call and put are quite cheap in absolute premium. Therefore, market participants are generally willing to pay up more for the tail risk premium. Last characteristic is term structure. Recall from earlier, implied vol is different across different tenors. This is due to difference in market sentiment for short-term versus long-term. Plotting ATM vol against tenors gives us the term structure of the vol surface, which is the white line in the graph. For normal markets, short-term vol is lower than long-term vol. In extreme or distressed markets, short-term vol is higher than long-term vol. As quick recap, vol surface is formed by continuous series of vol smile across tenors. Vol smile can be characterized by its skew and its convexity. Term structure of vol surface is referred to as the ATM vol across tenors. Understanding vol surface is important because vol surface tells the implied vol for different tenors and strikes. Skew of vol smiles measure the demand on put versus call, and term structure measures market expectation of short-term versus long-term market volatility. Combining these two, traders can get insights into the current market sentiment and, more importantly, formulate optimal option strategies. This is the end of Chapter 4. Subscribe and visit Ito Analytics website for more option-related materials.